So let's talk about stop losses and risk management, arguably one of the most important things when it comes to trading. If you've been watching my videos up to this point, I have a very unique way of going about it. I'm a big fan of having a position go in my favor very quickly, or I need to do a good job at just getting out of it. Now that's my way of going about it. That's what works best for me. There are a lot of different ways to approach stop losses and risk management. And I kind of want to just go over another one that I think is really interesting. And I actually got this from Oliver Velez. He has an awesome YouTube channel where he posts a lot of good content. I kind of like the idea of not losing more than one candlestick. So for some reason, I don't do a really good job at getting out quick and it starts to go against me. If I'm long, I want to stop out on the candle that I got in on, especially if it's a big candle when it breaks the low, or if for some reason it happens to be a thin candle, kind of the prior candle low, and then vice versa. If I'm short, I want to stop out on the high of the candle that I got in on, or that one just before it, if for some reason the candle I got in on is kind of a tight range. So that way I'm never losing more than one candle. It's a very interesting concept, and when you look at it from the perspective of a short-term trader, it does make sense because it still kind of applies that I want it to go very quickly in my favor, but sometimes that quick in my favor can be confusing because it goes in your way, it bounces a little bit. I see a lot of times in comments where people get very confused. They're not really sure exactly where to stop out. I'm a big fan of getting out pretty quick, but here's another interesting way of looking at it. The really awesome thing about this is that it's very simple. It's not overcomplicating the process. It's not using an indicator to make a decision. It's not staring at the level 2 and the time in sales to try to figure out when things are going to turn, or maybe you see something there that's not. It's using the candlesticks to make decisions, when to get in, when to get out, and in my opinion, those are the best indicators. I have a saying that I like to use, which is the candlesticks and the price action are going to tell the story. So when it comes to that, I think it's the most important thing when it comes to trading. The candlesticks, in my opinion, are everything that I need in order to put trades on and then make quick decisions once I'm in that trade. So now let's go over some examples on Tesla. And the really cool thing here is there's going to be a couple patterns that I talk about all the time when it comes to my YouTube videos and in my day trading options guide. So just to break it down, these are going to be 2-minute candles. That very first candle closed green. So it looked like buyers were strong, but then sellers started to come in because look at this big topping tail. And then that next candle, big red candle, got below the 9 EMA and the VWAP. So this is a 2-minute downside opening range break. So I'm always going to try to anticipate the new low. So if I'm really good, I want to try to get short just before it makes that new low. And then I have that line in the sand. I want to see it break and I want to see it start to speed up in my favor. If it starts to bounce, I'm just going to get out. But that's my way of going about it. Here is another interesting way of looking at it. Now, this just depends on risk tolerance. But if I'm going to end up getting short in this area right here, then I would think my stop should be the high of the candle that I got in on. Why? Because that was the reason that I got in. Sellers started to take control. I got a clear red candle, which showed me that this is a possible reversal. So I would think that if it gets above that spot, then maybe I need to get out because it's going to start to go the other way, because I would think that there are other people who see the same thing. And being that this was such a big red candle, if a lot of people piled in short and it starts to reverse and then it gets over that high, who knows? Maybe it could make a new high a day, and I don't want to be involved in that much pain. And this is a pretty good example because it did break down and then it bounced a little bit. And a lot of times I'm just going to get out of that trade, try to be flat on it and not worry about it. And then I can always look for another setup again. But this just shows that it never got to that candle high. So even though it bounced a little bit, it was still below the indicators that I always talk about, the 9 EMA and the VWAP. And it had that prior candle high, or the candle that I got in on. The high of that candle, that's the area that I need to be focused on. And as long as it stays below that, then technically I would never stop out. Now, I am not a fan of being in trades for a long time. So when it comes to taking my winners, the moment I get a quick move in my favor, I'm always just going to take those profits. But it's pretty clear to see the spot that I would need to get out on if this thing started to reverse. And this is an example of where it never got to that and then has a nice move lower. And of course, as it moves lower, that's where I'm just going to take those profits. Now let's go over another one. So this ends up really selling off, stays weak, below the 9 EMA and the VWAP, forms the bear flag, a pattern that I talk about all the time. And then here's how I see it. So what I'm trying to do is I'm always trying to anticipate that new low. And the new low is right around 189. So if I'm pretty good, I'm going to try to go short just before it makes that new low. And then same concept here. If this is the candle that got me in, then I don't think it should ever get back above it. So the stop would be at the high of that candle. The reason why that I think this is great is because sometimes things don't follow through immediately, but they still stay relatively close to the lows. Like this had a little bit of follow through and then it bounced just a little bit, but it still stayed weak. So a lot of times these little bounces, people can get freaked out at, but it's hard to be in a stock and have it go your way every single time right when you get in it. Sometimes it bounces just a little bit, but knowing that it's still weak, it did form the bear flag, the trend is lower. As long as it's below this candle high, then I would think there's no reason to panic. And then once it remains weak, kind of confirm this bear flag, made a new low, broke the low of that prior candle, and then has a big washout, that's where I'm going to be taking profits. And really how I see this is kind of worst case scenario. A lot of times I get in at the spot where I'm anticipating a new low or a new high, and I can get out relatively quickly if it doesn't go in my favor, but I am far from perfect. So if for some reason something happens, there's a lot of volatility, it moves against me quickly, this is how I'm going to be thinking about it. That mindset is worst case scenario. I don't want to lose a candle. Let's try to get out on the candle that I got in on, or absolute worst case, the prior candle, high if I'm short or low if I'm long. And this is a very interesting topic and something that's probably a lot different than people are used to when they're talking about stop losses. But this is just kind of a cool way of thinking about it based on somebody else that I've learned a few things from, and they talk about it consistently and it seems to really make sense. Now, just because it works for them or it works for me does not mean that it's going to work for you. That's why when it comes to trading, trial and error is going to be the most important thing. If you end up trying something and it just doesn't feel right and the results are not positive, then that means that it's probably not for you, and that's okay. It's time to move on. Continuously try new things and try other stuff until you find something that works best and feels comfortable, and then go all in on that. So that was a quick video on an interesting way to implement stop losses when it comes to trading. Hopefully you got some value from the video. I appreciate you watching. Feel free to like and subscribe, and I'll see you in the next one. Thanks for sticking around to the end of the video. I just want to talk about a couple cool things that I have to offer. The first is going to be my newsletter watch list. This is exactly what I post on my private Twitter 30 minutes before market open every single day. I do a quick analysis of the overall market, the SPY and the Qs, if there's any major market news that day, and then all the stocks I'm interested in watching, it's usually 4 or 5, if there's any major news tied to them, and all the levels that I think are in play. To the left, this is exactly what I'm posting on my private Twitter. I make sure to add that newsletter. I take a screenshot of the charts, green line to the upside being long, red line to the downside being short, and I make sure to highlight those 2 levels above. This is everything that's going on in my mind and my game plan going into each market open. Also, I make sure to add a little mental note because every day is slightly different, and here's an example of that. And if you want something that's a little bit less of a commitment, I do offer a live one-on-one call for 1 hour. This is where you can ask me questions about my journey, go over setups specifically, everything that I've gone through as a trader. Whether you're beginner or advanced, this is a great way to connect with me. So if you're interested in my private Twitter or the one-on-one live call, feel free to go to callmattdiamond.com or check out the links in the description below.